Hello, this is Elio D'Amato from Lincoln Indicators, the makers of Stock Doctor. For the next few minutes, I will take you through what is going on in the market. Well, it certainly has been an interesting month for the market, with geopolitical issues dominating most of the commentary in recent times. So going to the markets, we note with interest that the All Ordinaries Index has, joined in on the volatility this month, with it initially touching lows of 5,700, then rising close to the 6,000 mark on the 12th of April, to now be pretty much back right where it started, up some 0.3% at the time of recording. This is really not an unusual scenario for those of us who have watched the market for some time. Well, in the US market, however, they've had a tougher month as the Trump trade lost some of its lustre and concerns started to be felt as to whether President Trump would actually be able to achieve any of his agenda in a meaningful form. Well, this is the narrative anyway. The reality, as is evidenced by this chart, is that the US market has had a stellar run and therefore it probably just needed to take a break. Dissecting the Australian market into sectors, let's have a look at some of the best and worst performing over the month. Starting with the best, and despite the negative talk around bond proxies in a rising interest rate environment, property trusts return to favour, as investors have come to realise that a rapidly rising long-term interest rate is really not going to occur tomorrow. Investors have been jumping back on board following what was a very harsh sell-off between August and November late last year. It is a timely reminder to everyone that the moment that you think the market is predictable, you'll probably get it wrong. The best performing companies in the sector amongst the ASX 200 for the month were Abacus Property Group and GPT Group, that all grew basically by a full year's distribution in 1 month. Of course, we do note that most property trusts are currently trading, in some cases, well above their net asset value. So implementing a disciplined profit-taking and rebalancing strategy for your clients is advised at this time. Another sector to do well was the energy sector, who until a week ago was actually the market's best performer. The comeback was basically due to oil prices which fell, with production lifts in the US and a slower reduction in stockpiles than expected being key reasons for the late sell-off. Now, while oil prices play a large role here, the recent challenging environment faced by a number of businesses in this sector means that a number have taken drastic steps to get their businesses in order, mean and lean. Well, that is until the cycle moves in favour of oil prices again, and they really should benefit. The best performing companies in the sector include Origin Energy, Worley Parsons and Oil Search, with Worley Parsons subject to speculation that a Middle Eastern consortium may buy them out. Turning our attention now to the worst performing sector for the month, and we have a clear leader in this regard, the telecommunications sector. Unfortunately, the sector has experienced extreme pressure over the last 12 months, and most recently has come under deeper scrutiny following an announcement by TPG Telecom that they had acquired 2 new wireless mobile spectrum that would now allow them to become the 4th major mobile telecommunications provider in the market. Well, the market wasn't happy, as this means increased competition, and therefore all stocks in the sector were sold off. The market wasn't happy with TPG either, because they thought they paid too much. So really, there wasn't much love there. Looking at the individual stock performances for the month, we see that Vocus Communications continues to have increasing doubters, with 11% of its stock currently shorted. There are many questions around its recent transformational acquisitions and whether they will work. And further to the TPG announcement, Telstra, who has the potential to lose the most from the entrance of a 4th competitor, is also starting to see some questions around the strength of its future dividend capacity. Well, this risk is something that we agree with and was a catalyst for it being removed as a star income stock from our stable a few months back. The other big item this month was the rise of geopolitical concerns in the Korean Peninsula, as the US became increasingly vocal in its disapproval of the North Korean armaments program. With so many regional economic powerhouses in play, namely China, Japan and Korea, there are concerns that conflict in the region could spark a sell-off. Not just here, of course, but around the world. Throw in a range of other issues such as Russia, Syria and Europe, and well, there was no surprise to see that the gold price rose over the month, touching close to $1,300 an ounce. In a portfolio, it plays a role of a hedge against volatility. That said, they are real businesses that generate revenues, pay expenses and are subjected to external factors like weather, mine incidents, currency movements and of course the price of gold. It's important we do this because though gold is considered a store of value, unless you hold a gold bar or underneath a mattress, well, gold miners can really often swing due to factors more than their underlying performance and commodity price. And finally this month, Lincoln Indicators produced our semi-annual Health of the Market report. Using our proprietary financial health score, we dissect the risk of every company on this stock exchange, and we look closely at their risks. Now to date, our health score has correctly identified 90% of all corporate failures since it was implemented in 1984. In the latest report, we can confirm that there's both good and bad news for the overall market at the end of 2016. The good news was that the number of strong and satisfactory companies, that is, those that are deemed to be exposed to manageable levels of financial risk, actually improved from 12 months ago, from 27.5% to 28.2%. And herein lies the bad, where we have over 70% of companies exposed to unacceptable levels of financial risk classified as either early warning, marginal or distress. Now often this is symptomatic of our market having a large number of constituents in startup phase, where capital raisings are required in order to keep the idea alive. However, the above statistics are one of the key reasons why our market is often perceived as high risk by many global investors. I'm Elio D'Amato from Lincoln Indicators, and thanks for watching.